On this week's program, we're going to talk about some of the non-financial issues to consider in retirement. Plus, if you've got money, or should I say some extra money, we're going to get into the conversation about whether you should be paying your mortgage off or investing that money. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you this week change your life with a successful and cost-effective financial plan. So, busy week this past week, just getting back into town yesterday, driving all the way up to Charlottesville. If you're wondering how far of a drive that is, it's a long one, but I was dropping my middle son off for his first year at the University of Virginia. Very excited. They have these things up there that we don't see much in Florida, and they're called hills and mountains. And I had the opportunity to walk up and down a hill quite a bit because his dorm, the dorm was like completely built on the side of a hill. So you had to go like up like this ridiculous amount of stairs. And anyway, we got it. We survived it. He's all moved in and getting adjusted to his new surroundings. But we certainly miss him, as I'm sure many of you who dropped kids off at college this past week. Facebook was lighting up with all these pictures of kids getting dropped off. And in fact, last week, if you've got questions on how to pay for it or some of the tax credits involved with college, then you certainly want to check out our episode of the podcast from last week that talks a lot about that. Also, coming up today, and this is pretty exciting, you know, for years and years and years, we have shared with you on this program that we have a face for radio. Not really for television. I'll let you kind of get the chuckle in there on that joke. But the reality is that today at noon, we're going to be actually featured on a television show called Best of Central Florida with Justin Clark and Michaela Nichols. It's a program that airs at noon on the local CBS affiliate. That's WKMG here in Greater Orlando proper. On my cable thing, it's Channel 6. So if you're in and about and watching TV, watch us today at noon on the Best of Central Florida. Our firm, Nelson Financial Planning, was actually named the People's Choice Award winner for the Best of Central Florida. So very excited about getting that honor. And also, we were in the studios, not this past week, but the week before, taping the program. So you'll get to see us on television here today at noon. So we appreciate the opportunity to join the Best of Central Florida with Justin Clark and Michaela Nichols' crew, and certainly an honor to be awarded the People's Choice winner for Best Financial Planning Firm in Central Florida. So anyway, that's a long introduction. Let's start to tear into some of the meat of the substance, if you will, that we want to talk about on the program this week. You've often heard the expression, right investments in right account. Okay, and we wanted to take this segment of the program and talk a little bit about what exactly does that mean, but having the right investments in the right account. Well, it starts with sort of understanding a few concepts and then sort of tying them all together. The first concept that you have to think about when you're talking about the notion of having the right investments in the right account is, well, what are the account choices available, right? And basically, we're going to focus on the main two categories, if you will, out there, one of which is tax deferred and one of which is taxable. And be careful, because those names can kind of be a little bit deceiving. Tax deferred generally means that it's a vehicle that maybe you didn't have to pay any taxes on it when you put the money in. it's growing tax deferred, meaning you don't have to pay taxes along the way until such time as you take it out. Well, the obvious example of that is an IRA or a 401k or a 403b or a 457, right? Put the money in. It's growing tax deferred. You're not responsible for paying taxes along the way. You pay taxes when you take it out. Hence the notion of tax deferred. Now, the other type of account is taxable. Now that sounds like, well, wait a minute. That means that I've got to pay taxes along the way. Then that's exactly correct. But it also means that that account is getting funded with after-tax money, meaning the taxes have already been paid. And as it grows along the way, as you pay the taxes along the way, then ultimately that all adds into what is known as the cost basis of that account. And so consequently, the growth only on that account as you use it winds up being taxable. So understand the two main types of accounts. You've got tax deferred and taxable. It always sounds like when you kind of describe them in those terms, well, why would I want a taxable account? Well, the reality is we go to sort of the next thing that you need to think about, and that is the tax implications, right? So the tax implications of these two types of accounts obviously are very different. On a tax deferred account, anytime you use that, that will be at ordinary income tax brackets. That's the same tax rate that applies to your work income, for example, right? And then when we think about a taxable account, generally speaking, you may have the ability to have the vast majority of that tax as a capital gain or a qualified dividend. Those tax rates are at different rates, and in fact lower rates than the income tax rates that would typically apply for taking money out of a tax deferred account. Okay, so you get that on the table. Okay, I've got income tax rates, and then I've got capital gain dividend tax rates. Capital gain dividend tax rates always less. Income tax rates always more, at least under the current tax code. Okay, so we've talked about type of accounts, we've talked about the tax implications, and then of course we got to talk about types of investments, right? So you can have stocks, which generally have capital appreciation, pay dividends, things like that. Things that by their necessity make them more aligned with having a capital gain or dividend tax rate on them versus bonds, which ultimately pay interest. So if I'm a bond and I pay interest, then that's going to be taxed as ordinary income. Okay, so now to put it all together, if you think of it this way, if I have stocks more in my taxable account, then I'm able to take advantage of those lower capital gain and dividend rates. Also, because stocks have the potential for greater appreciation, then I'm going to be able to take advantage of the step up in basis that applies on a taxable account when I pass away. So to have the taxable account be the bucket, if you will, for greater amounts of appreciation, that makes some good sense. Meanwhile, on the tax deferred account, where every dollar that I'm taking out is going to be taxable, that's where more often than not, again, not to talk in complete specifics, but I think these are some general concepts that folks need to take advantage of, is on the bonds with the interest, that is taxable as ordinary income. So it would make more sense to have your bonds in your tax deferred account. We're going to wrap up this concept, but we're going to need to take a break. So when we come back from the break, we're going to kind of wrap up this concept of having right investments in the right account. And then we're going to start talking to you about a non-financial issues that you need to think about in retirement. Coming up next here on Dollars and Cents. Talking about having the right investments in the right accounts. That concept that you hear a lot about, we were talking at length about it in the opening segment. It boils down to understanding the types of accounts, tax deferred versus taxable, to understanding the notion of what a stock does, more on the capital appreciation, paying out dividends, versus a bond generating out interest, less capital appreciation, to understanding then the tax consequences of that difference. capital gains, dividends taxed at lower rates, interest taxed at higher rates, the same rates as ordinary income tax rates. So to put it all together, if you think of your portfolio as a whole, and it really requires you to really get down into this level of detail where you're looking at the types of accounts and thinking about, okay, well, what types of investments do I want to have in each individual account? Because a lot of that decision is going to be determined by the tax implications. So the general rule or the generalization that we want folks to be thinking about is that in a taxable account, you want to have the assets that have the potential for the greatest amount of appreciation that then would trigger capital gains, that then would trigger things like qualified dividends, so that those are in fact taxed at a lesser rate. The important concept as well is that if you have more highly appreciating assets in those taxable accounts, then you're better able to take advantage of the notion of the step up in basis, so that when you pass, the value of those from a tax perspective jumps up to be equal to the date of passing. So then if you're going to be able to take advantage of that concept, then you certainly want to have assets that are appreciating in that taxable account. Meanwhile, if you flip over to a tax deferred account, then every dollar you take out of that is going to be ordinary income, right? And that means that if in those cases where you have your bonds that pay interest, that interest already taxed as ordinary income, so you're not losing anything in terms of the effective tax rate on that income. Plus, bonds generally less return than stocks, so then that also holds things in check, like your required minimum distribution, potential tax implications to your beneficiaries, because they're going to have to pay all of the tax on those tax deferred accounts now within a 10-year period of time as a result of the elimination of the stretch IRA. So certainly some things to be thinking about in terms of that concept. Right investments in the right account. A couple of side notes in terms of charitable contributions as well. There's definitely some unique aspects to being able to do a qualified charitable distribution with a tax-deferred account. Similarly, gifting shares of a stock or a mutual fund to a charity from a taxable account is a great way to do that. In both cases, you want to make sure that you follow the parameters. If you're doing a qualified charitable distribution from a tax-deferred account, an IRA account, then you've got to make sure that that check is made payable directly to the charity. Similarly, if you're doing a gift of appreciated assets from a taxable account, then you want to make sure that that goes over to the charity as the position. Don't sell the position and then give the money to the charity. You want to send that position over to the charity and have the charity sell it, because guess what? Charity is a 501c3, it doesn't pay taxes, so then you avoid the entire tax implication of the capital gain, but you get the full charitable deduction for the amount of the gift. So a lot of things to be thinking about. The notion of the right investment in the right account really is a pretty important one for all investors. So make sure you sort of think through these concepts that we've just been talking about here on the program. All right, so we're going to shift some gears. We're going to talk about some of the non-financial aspects of retirement. So welcome to Dollars and Cents. We're Central Florida's longest running radio program, coming to you on a variety of networks throughout the Central Florida region. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. So when we think about retirement, you often hear folks talking about all of the financial stuff, and that's certainly pretty important when it comes to determining whether you're going to have a successful retirement, right? You want to look at what you own, what you owe, money in, money out, all of those concepts. Obviously very, very important. And we've certainly spent plenty of time on prior episodes of the program talking at length about those concepts. And so certainly the analysis of retirement has got to start with looking at the actual numbers, looking at the finances. But there's also some important non-financial considerations that we think bear discussion in the conversation about retirement. And we wanted to share some of those things that we've sort of learned over the 20 plus years of doing this that really kind of jump out and come to mind. And I think, one of the things that people are most concerned about when they think about going into retirement is, they're concerned about this notion of, I might get bored, or I might not have, enough to do. And I think that is important, because your routine that you've had for the past 30, 40 years is now going to be completely different. And I think it's important to just pause as you're thinking about the financial part of retirement to really think about what your plan is for how you're going to spend your time. Much like you would have a plan financially, you want to have a plan socially and mentally and physically that also covers those non-financial aspects of retirement. And I think what's important to do is to start to execute that partially while you are still working. Make sure that you are going to be able to have some kind of a schedule and do the kinds of things and get involved in the kinds of activities that will not make it boring. And that's hard for a lot of folks these days, but to really be thinking about what you're going to do with that spare time and have a plan and to start to sort of execute it while you are still working to see if it's going to really work out. Another thing that is important to be thinking about is sort of the timing of income. A lot of folks, you're used to that regular paycheck, right? And in retirement, you don't really have that level of regularity unless you think through the timing of that income. For example, a pension payout typically only comes once a month, right? And Social Security, again, once a month. And oftentimes with a pension or Social Security, you don't get to pick the date or the time of the month that actually comes into your checking account. I mean, that's sort of etched in stone by third parties. So when you're thinking about other parts of income that are going to be generated from perhaps money that you have saved, then you really want to be thinking about the timing of, okay, well, when is that going to come in, and how do I best complement the other parts of income that are coming in on a regular basis. Another thing to think about, and this is probably one of the biggest things to be thinking about, that is sort of a pure non-financial nature, and that of course is health insurance. Boy, that is the big one out there, particularly if you're trying to retire early prior to Medicare age at 65. How do you get it? How do you pay for it? How much is it going to be? And again, those are the kinds of things that you might not necessarily really grasp when you're thinking about the financial aspect, because for most people, their employer pays it. When you retire, hey, you're going to have to pay it all on your own. So those are the kinds of things on that kind of that non-financial list. Payment of income taxes, same kind of concept. Health insurance typically paid for by your employer, or at least part of it. Income tax, it's not really paid for by your employer. It comes out of your money, but you don't see it. So you need to kind of put that into the mix and determine how much that's going to be, and ultimately get that collected and have that be paid in on a monthly basis. And certainly socialization, right? I mean, a lot of folks, when you go to work, right, at least pre-pandemic, we're all working from home, so maybe we're not getting the socialization that we once were, but ultimately work provides a high level of socialization. So if you're going to retire, you need to think about, okay, how am I going to replace that level of socialization and that I typically get when I am working. So some of the things that you need to be thinking about on a non-financial side when it comes to retirement. We got a couple more concepts that we'll share with you on this same topic after we take this break. So we'll return after this break here on Dollars and Cents with your host Joel Garris of Nelson Financial Planning. On the program, we are talking in this segment a little bit more about some of the non-financial considerations to be thinking about when retirement. I think everybody, when they think retirement, it's about numbers, right? Money in, money out, what you own, what you owe. And certainly, if you're going to plan your retirement, you've got to look at that. But there's some non-financial considerations as well that we think it's equally important to make sure that you are thinking about things like making sure that you've got a plan in terms of how you're going to spend your time so you're not bored. How is the timing of your income going to be coming in? How are you going to pay for health insurance? How's that income tax thing going to be withheld along the way? Certainly some non-financial considerations to consider. We got a few others to also share with you as well. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your money. If after you're done with the program, if you don't have anything else to do, today at noon, yours truly, Joel Garris, is going to be featured on the Best of Central Florida television show on WKMG Channel 6, which is the CBS affiliate here in the Orlando market. I'm very excited that our firm, Nelson Financial Planning, was selected as the People's Choice winner for the Best of Central Florida show with Justin Clark and Michaela Nichols. So we're excited to have had that honor. So if you're inside, I don't think it's going to rain later on this afternoon. So, but anyway, if you're in, want to beat the heat, happen to be watching TV, make sure and check us out on Channel 6, the CBS station, at noon on the Best of Central Florida show. So we are talking about some of the non-financial factors to consider when it comes to retirement. Certainly went through a lot and recapped them here earlier in this segment. A few other things to also sort of put in that mix, and that is what's going on at home, right? Is there still kids at home? Is there maybe older kids that you wish weren't at home that are at home? And maybe depending upon what's going on at home, that may put you on a different trajectory or a different timing for retirement. Are those kids moving back? Are there grandkids at home? Maybe you want to be there, maybe you don't want to be there, depending upon the situation. But it's important to think about what's going on the home life front as well when you're thinking about retiring. And then, sort of where do you want to live? It's fascinating, how quickly, and I remember a conversation this past week with a client who wound up moving to Boston, and now they're in Boston, and they went and moved there because one of their kids was there, and it looked like that they were going to be there for a long time. Well, not more than 1 year after they made the move from Florida to Boston, their son wound up moving to the Midwest. So you can see where the notion of where do you want to live can really complicate things from a retirement perspective. So make sure you think through that and talk that one through, not only as a family, but really among the different generations in the family, particularly if you're thinking about moving to where the kids are or the grandkids are, because that could potentially change. So again, that's a big non-financial issue to sort of be thinking about in terms of location and ultimately where you want to ultimately reside in retirement. And similarly, what do you want to do? I mean, if one spouse wants to travel and the other one wants to garden, those are two very different kinds of things. So it's important to sort of talk that through in terms of getting a handle on what retirement is going to look like. So it's more than just the X's and the O's. It's about having a plan and thinking through to make sure that you're not going to be bored, to make sure that health insurance is covered, income taxes are covered, where are you going to live, what are you going to do, how are you going to socialize and still interact and keep that mental health up, keep that physical health up, keep that social health up. All very important sort of non-financial things when it comes to thinking about retirement that a lot of people don't quite think through. So we wanted to kind of share some of those topics on the program today as well. So we're going to shift some gears now and talk about another topic that we teased at the top of the program, and that's this notion of if you have extra cash, right? What do you do? Should you pay off your mortgage or should you invest it? And there's a lot of pros and cons to think about when you engage in this conversation. And so we wanted to give you sort of some hard numbers and sort of talk it through, if you will, here on the program this morning. So we're going to start with a very, very simple example. $200,000 mortgage, 30-year, 3%. A side note, as I sit here today and talk about a 30-year mortgage being at 3% fixed rate, I can assure you that when I started out in this business, I never would have thought that was possible at that low of a rate. But hey, it is what it is. Interest rates are very low. Make sure that if you are borrowing any money, that the rate is fixed, because I don't think they're going to stay there forever. Anyway, we digress. $200,000 mortgage, 30 years, 3% fixed rate. That's basically representative of the current environment. Your monthly payment, principal and interest, not the taxes and insurance part, because that's different depending upon the house and where you're at and things like that. But the pure principal and interest payment on that is going to be $843 per month. Okay? If you add $1,000 a month to that, all right? So you make the payment $1,843, so an extra $1,000 a month, you will find that you will get that 30-year mortgage paid off in about 10 years and 7 months, saving you a total of $69,952 in interest, so about $70,000 in interest. Okay, so here's the pros, right? You saved a bunch of cost in interest. That's number one. It's certainly not having debt, I think, is a big peace of mind issue, right? If you don't owe anybody anything, that's a good feeling to have, let's face it. And because of that, once you have that eliminated, then you no longer have that payment. Maybe that frees money up to focus on other debt. Certainly, if that's the case, I might advise that you perhaps focus on the other debt before you focus on the 3%, the debt that's only costing you 3%. But it does certainly free up cash flow and allows you to sort of focus on savings. And I think the other thing to be thinking about, particularly in today's world, is that many people don't have any tax savings, at least under the current tax code, don't have any tax savings on their mortgage interest. I think a lot of people are still of the thought of, well, I've got mortgage interest, but it'll help me save on my taxes. The reality is that it really doesn't for most people. Estimates have the number of people who itemize their deductions, which is what you would need to do in order to have your mortgage interest be a deduction on your tax return. Most estimates have that number down to between 7 to 9% of the American population. So that's less than 1 in 10 that can actually take their mortgage interest and have it save on them something on their tax return. Reason for that, much higher standard deduction. Married couple, $24,000. In this example, where we're talking about a $200,000 mortgage, you got about $6,000 of interest. $6,000 of interest plus your real estate taxes, plus your charitable contribution, plus the other things that you can itemize. Generally, you ain't going to get to that $24,000 figure. So in terms of pros of paying the mortgage off, the reality is that you're not losing out. People say, oh, I'm going to lose out on a tax deduction. The reality is, more often than not, you're really not. It doesn't move the picture that much. Now, on to the downside of ultimately paying that mortgage off and paying that off quicker. The reality is that you've got a cash flow, right? We talked about in the example where you're putting an extra $1,000 a month. You're basically doubling up on your mortgage payment. Not many people can do that when you stop and think about that. And then certainly if there's a change of income, right, then that would certainly derail the plan, if you will. But the other part of the question is, okay, well, there's always an opportunity cost, right? An opportunity cost is basically a fancy word that says, hey, if I got money, what are the other options that I could use with that money? Well, we just looked at, okay, what if I put an extra $1,000 a month on my mortgage? I take a 30-year, I pay it off in 10 years and 7 months, and I save about $70,000 of interest. But what if I invest that money? And we've got some interesting numbers to share with you on the investing side, because if you take that same $1,000 a month and you assume an average return of 8%, which is sort of what the market's generated over the course of the past 70, 80 years, and you kind of run the numbers on that extra $1,000 a month over that same 10-year and 7-month period of time, you'd find that you have a balance of about $182,946, or in excess of $100,000 more than what you saved on interest. So some important things to be thinking about here, particularly when you start to look at the numbers. On a pure numbers basis, it would be a no-brainer, right? I'm going to invest the money, I'll come out ahead. That's great. Problem solved. It always gets more complicated than that. And we'll talk about some of the complications when we return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the concept of, do you pay off your mortgage or do you invest the money? We gave the example of a $200,000 mortgage, 3%, 30-year fixed rate. And if you put an extra $1,000 to that payment, then you wind up saving about $70,000 of interest. And that's all fine and dandy, but that's certainly a cash flow item to consider, that is for sure. But at the same point in time, you take that $1,000 a month and put it and invest it in just sort of using the normal rate of return of the markets over the course of the past 70, 80 years at about 8%. You'll find that that $1,000 a month over that same 10 years, 7-month period of time grows to be about $183,000 or about $110,000 more than the notion of how much interest you saved on the mortgage. So there's certainly some numbers to take pen and paper to. The reality is that when you sort of look at them, it's one of those things that, as with anything financially, it always involves more than just the numbers, right? We were just talking about that earlier in the program about some of the non-financial things to be thinking about when it comes to retirement. We think that there are certainly some non-financial things when it comes to whether you pay your mortgage off or whether you pay the money. The reality is that when you pay your mortgage off, you no longer have that debt to worry about. And isn't the concept to really ultimately get rid of debt, particularly when you're going into retirement? Because if you don't have the debt, then you don't have to worry about making the payment and making the cash flow. So we think that helps to illuminate sort of the balance to strike in this conversation, because there's no right or wrong answer, as with anything in life. So we're going to talk about the balance sort of that we like to suggest or strike with folks when we're thinking about that. But first, we want to certainly welcome all of our listeners to the program here. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're coming to you across a variety of stations here in Central Florida. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite social media or podcast channel of choice. Also named the People's Choice winner on the Best of Central Florida television program to air today at noon on the CBS affiliate WKMG Channel 6. So make sure that if you're around a TV to check it out on the program today at noon. Excited about the opportunity to join the co-host Justin Clark and Michaela Nichols and really have an opportunity to kind of chat with them. A nice honor for our firm at Nelson Financial Planning. So how do we balance sort of all of this conversation about what to do about the mortgage? And I think one of the things that also sort of skews the conversation a little bit is that you don't get the tax deduction on the mortgage interest like you used to. Let me clarify that statement. Mortgage interest is still very much deductible, but many people find that with the tax rules being what they are and these much higher standard deductions that you have, that ultimately you really don't get the ability to write that interest off like you used to. So I think that kind of changes the analysis potentially a little bit. I think it's also to think about how that would work in terms of cash flow. If the goal is to be debt-free in retirement, to not have that payment, then one of the things that we encourage folks to do is think about how many years they've got to retirement and how much money is left on the mortgage. And then think about, okay, how could I cash flow this to make sure that I have the mortgage all paid off before I get to retirement? And if you go online, there's, if you look up an amortization calculator, that will tell you exactly what you need to add to your current mortgage payment to have it all paid off by the time you retire. We think that's an important exercise for folks to do to understand that number. Now, having a mortgage that has a longer time period, 30-year versus 15, gives you the flexibility that if anything changes, that you can revert back to just making the required payment that is necessary under the mortgage. And on a 30-year, that's always going to be less than a 15-year because the payments are stretched out over a 30-year. But if you do the calculation and figure out, okay, here's how much that I can add to it, then ultimately you really do set yourself up on a pace to make sure that that is all paid off within that certain period of time. One of the things that we do try and avoid in terms of the thought process on this is, let's say you found yourself with $50,000 or $100,000 lump sum, just for whatever reason. The thought is, okay, well, should I take that chunk and should I do that as a full down payment on the mortgage? And I think more often than not, we would typically say no in that, because that's where you start to really kind of look at that opportunity cost and the numbers that we were running in terms of how much more that you make by investing that money really comes into light. Because if you're talking about a lump sum of money that has a long period of time, remember the examples that we were giving in the segment had to do with $1,000 a month put in gradually over the course of a 10-year plus period of time. In the example of a lump sum of money, if you take that lump sum of money and invest that, then you've got a long time frame for that to grow and compound, making an even bigger gap in comparison to the amount of interest that you would have saved. So we think if there's a lump sum that comes into account, that we think that the opportunity cost would bear that to try and be invested and to really follow sort of this cash flow pattern on the mortgage. Make sure it's paid off before you retire. Obviously, that's the best case scenario, but really be thinking about what that means from a cash flow perspective, if you will. So certainly some interesting thoughts on whether you pay off the mortgage or not that we wanted to share with you here on the program. We've got a great program coming up next week, and I'm going to tease it early. Rob Field, who is our resident certified financial fiduciary, also happens to be a national Social Security advisor, going to be joining us on the program. He's been a member of the team at Nelson Financial Planning for a number of years. We're going to talk an awful lot about Social Security, some of the rules involving Social Security. So make sure you mark the calendar and join us next week on that program for an in-depth conversation about Social Security. Thank you for listening. Enjoy the rest of your Sunday. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.